Okay, so valuing a business. When you're valuing a business, you're really going to look at it in maybe one of three ways, maybe all three ways. One way of looking at a business is to really look at like businesses and find a like business, find out what the competition is like, find out if the business that you're valuing is similar to another one that you're looking at, but maybe is an even better company. So maybe it should be valued more than the other business. And that's kind of it's a less scientific, you're really looking at the market approach to a business. If you want to look more specifically, you'll look at income, see what the business produces for income. That's a really good way to look at the value of a business, is find out what the business produces every year. And if that level of income is very high, it might be a great investment to be putting money in, purchasing that business, and get a great return on your initial investment. The other way to value a business, and this is also very common, is to look at the assets. And the assets will not only be the cash on hand, won't look at working capital so much because those are just covering the normal operations, but you'll look at the larger holdings of assets. You'll also look at maybe things like equipment, facilities, the buildings that they use. So really, probably the two more scientific methods are looking at the assets of the business and getting the valuation that way, or looking at the income that they produce and seeing really what the return on investment would be with a purchase of the business. Looking at the market value as compared to other businesses, maybe a little less scientific, but it's always a good thing to throw in there and just see what competition is like. You want to make sure that if you're valuing a business, and especially if you're thinking of purchasing it, that business is the strongest and maybe has a niche that the competition doesn't have.